We used a powerful AI model to create two intelligent investors, a value investor and a day trader. We brought them face to face in a debate to answer one question: which investing strategy truly comes out on top, and why? Before we begin, make sure to like the video, hit the notification icon, and subscribe for more. The debate begins now.
Welcome to the ultimate showdown: brains versus speed, patience versus precision, value investor versus day trader. Two strategies, two mindsets, two completely different ways of making money in the market. Tonight, we find out which one really has the edge. First question: can you each explain why you believe your method is the best and why you don't respect the other? Day trader, you're up first.
Gladly. Look, the market moves every single day. Prices shift constantly because of news, momentum, liquidity, fear, greed, all of it. My job is to take advantage of those movements in real time. I study price action, volume, momentum, catalysts, the live behavior of buyers and sellers. To me, the market is a battlefield. Every tick tells a story. Volume spikes, institutions are moving. Momentum builds, I ride the wave. Story changes, I'm out. Why is my method better? Because I'm adaptable. Bullish, bearish, chaotic, doesn't matter. Volatility is the opportunity. Meanwhile, value investor over here is reading 200-page annual reports, praying the market eventually agrees with his spreadsheet. That might take 5 years. I can make 5 years of movement in 5 minutes. I don't fall in love with tickers. I date them, make my money, and move on. He's over there married to stocks. I'm out here getting paid.
Oh, I see we let caffeine and candlesticks go first. Listen, I'm not here to gamble. I'm here to own businesses. When I buy a stock, I'm not buying a chart pattern. I'm buying a piece of a real company, products, customers, competitive advantages, long-term earnings power. Markets fluctuate constantly, but businesses build value over time. Great companies grow earnings, expand margins, deepen their moats. Buy them when they're undervalued, and time becomes your greatest weapon. Day traders are focused on the noise of the market. I focus on the signal. The greatest fortunes in the stock market were built by owning exceptional businesses for long periods of time. Buffett didn't day trade Coca-Cola. He held it. While traders are chasing the next candle, long-term investors are quietly compounding wealth. One strategy reacts to volatility. The other uses time itself as a multiplier. You make gains in minutes. I make fortunes in decades. And let's not ignore the statistics. 90% of day traders lose money. But hey, keep flexing that 0.5% scalp. I'll be over here collecting dividends and buying dips on your emotional breakdowns.
Oh, so noble. I buy businesses. Bro, you buy tickers that used to matter. You probably still own Blockbuster because the balance sheet looked nice. While you're being patient, inflation is quietly eating your returns alive. The market moves fast. Money moves fast. Information moves fast. And your strategy is slower than dial-up internet. You sit around hoping the market eventually realizes your spreadsheet was correct. I don't hope, I react. The difference is simple. You wait for opportunity. I hunt for it.
Timing the market consistently is extremely difficult. That's why so many traders burn out within 2 years. You might win today, you might win tomorrow. But over decades, the discipline of owning great businesses consistently outperforms the constant stress of trying to outmaneuver the market every single hour. And let's not pretend that's not stress. It's a full-time psychological war you're fighting with yourself every day. I'd rather be slow and rich than fast and broke. See you at the next bear market. I'll be buying your margin calls at a discount.
How do you handle losses? And what do you tell people who want to follow your path? Value investor, you're up first.
Losses? I don't fear them. I study them. A falling stock price doesn't automatically mean you made a mistake. Sometimes the market is reacting emotionally, panicking over short-term noise that has nothing to do with the long-term value of the business. If the fundamentals are still intact, strong balance sheet, growing earnings, durable competitive advantages, then a lower price is simply a sale. I'm not buying noise. I'm buying moats. If you liked owning part of a company at $100, you should love owning it at 80, assuming nothing fundamental changed. That shift in mindset is everything. Markets are emotional in the short term, but they are rational over long periods of time. For anyone who wants to walk this path, learn to read financial statements. understand how companies actually make money, develop the patience to think independently and ignore the noise. Because the market will constantly try to scare you out of your best decisions. Wealth isn't built in a week. It's built when you understand what you own and trust the process.
Oh, that's beautiful. But let me tell you what actually happens when you're wrong in trading. You cut it immediately. No emotions, no ego, no therapy session with your portfolio. I control my risk tighter than Warren controls a Coca-Cola can. Risk management is everything. Every trade has a plan before I enter. I know exactly where I'm in, where I'm out, and the maximum I'm willing to lose. You're over here treating losses like a philosophical growth experience. The fundamentals are strong, while the stock drops 40%. Cool story. Me? I treat losses like operating expenses, part of running the business. Losses aren't failures, they're tuition. For anyone watching who wants to be a trader, it is not easy. You need discipline, screen time, backtesting, a trading journal, and real emotional control. This isn't luck. This isn't a video game. This is a performance sport. The market is the most brutal scoreboard on earth. Without preparation and discipline, it will humble you every single time.
You know, I'll actually agree with part of that. Risk management is essential in any strategy. But here's the fundamental difference. Your strategy requires being right consistently. Mine requires being right occasionally, as long as the winners are large enough to more than cover the mistakes. That asymmetry is the entire foundation of great investing. One big correct decision held for years can outperform hundreds of correct short-term trades. 2% daily. On paper, maybe. In reality, 2% of your account and 98% of your sanity. You call it a performance sport. I call it compounding. And in every great competition, the calm general wins, not the guy sprinting around with no ammunition.
Yeah? Well, while you're compounding, I'm withdrawing. You buy the dip, I sell the rip. That's the actual difference. You're sitting there waiting for the market to validate your thesis, and while you wait, the market is moving thousands of points every year. Those movements are real opportunities that traders capture every single day. So while you're celebrating a 12% annual return like it's a championship, traders are actively generating returns in any market condition. But hey, enjoy the dividends, Grandpa. Your portfolio is showing.
What is the biggest mistake beginners make in your strategy?
Easy. Overtrading and revenge trading. Beginners think day trading means pressing buttons all day like it's a video game. They see one green day and think they figured out the market. Then one red trade hits, and suddenly they're doubling down trying to win it back emotionally. That is the fastest way to blow up an account. Real traders wait. We wait for the right setup, the right volume, the right confirmation, even if that means sitting on our hands for 3 hours. Patience is one of the most underrated skills in trading. The difference between amateurs and professionals is simple. Amateurs chase trades. Professionals wait for them. If the setup isn't there, the trade doesn't exist.
I actually agree with him, and I'm as surprised as you are. But beginners in value investing make a different critical mistake. They confuse cheap with valuable. A stock isn't a bargain just because it fell 80%. Sometimes a stock fell 80% for a very good reason. Bad business, shrinking industry, poor management, debt that can't be serviced. You're not buying numbers on a screen. You're buying the future earning power of a real business. The question is never just, is it cheap? The question is it cheap relative to what it's actually worth? That distinction separates investors who compound wealth from investors who slowly accumulate garbage.
Wow, we agreed on something. Mark the calendar. This might be a historic event.
What is the biggest myth people believe about your strategy?
The biggest myth about value investing is that it means buying boring companies and doing absolutely nothing. People picture some guy in a cardigan reading annual reports, falling asleep, and checking his portfolio once a year. Real value investing requires intense research, industries, competitive dynamics, balance sheet analysis, management quality. It requires the psychological discipline to ignore market noise when everyone around you is panicking. And it requires the patience to let the thesis play out, even when the market disagrees with you for months. That's not passive. That's incredibly demanding. And yes, the surgeon analogy only holds if the surgeon survives more than 5 years in practice. Most don't.
The biggest myth about day trading? That it's gambling. People say that because they don't understand what's actually happening behind the screen. Bad traders gamble. They click buttons randomly and hope something works. But skilled traders operate on probabilities, data, and disciplined risk management. Every setup we trade has a historical edge. Every trade has a defined risk and a target. We're not guessing. We're managing asymmetric probabilities. Professional trading is closer to elite poker than a casino. The edge isn't winning every hand. It's making better decisions than your opponent over thousands of repetitions. Over time, skill wins. That's not gambling. Careful, Grandpa. Your dividends are showing.
Markets aren't always green. What does a bad day look like for each of you?
A bad day in trading means the market is behaving unpredictably. Low volume, choppy price action, fake breakouts everywhere. Momentum builds and immediately collapses. In that environment, forcing trades is the fastest way to destroy your account. So, what do good traders do? We stop. We step back, reduce size, or don't trade at all. One of the most underrated skills in trading is recognizing when the market environment isn't favorable. Capital preservation is the first priority. 3 losses in a row? Walk away, reset. Come back tomorrow fresh. The worst thing a trader can ever do is try to emotionally win back money the market already took.
A bad day for investors happens when markets panic over short-term noise, a recession scare, a geopolitical event, an interest rate surprise. Prices fall fast, sometimes irrationally fast, across entire sectors. But here's what most people miss. That's also exactly when the greatest opportunities appear. When fear dominates the market, high-quality businesses often trade far below their intrinsic value. For disciplined investors, those moments are rare gifts. The biggest mistake investors make isn't buying at the wrong price. It's failing to act when the opportunity is right in front of them because the headlines are terrifying. When everyone else is fearful, that's when long-term investors quietly go shopping. A market crash isn't a disaster for me. It's a clearance sale.
So your worst day is actually your best day?
Exactly. And historically, the investors who bought aggressively during crashes, 2008, 2020, every major panic, made fortunes. The ones who sold made regrets.
If the entire market crashed tomorrow, who survives better?
Us. No contest. Volatility is oxygen for traders. Big moves, whether up or down, create momentum, breakouts, reversals, and volatility spikes. In calm markets, traders hunt for opportunity. In chaotic markets, opportunity hunts us. While long-term investors are watching their portfolios drop 40%, we're trading the chaos and potentially making money on the way down. Shorting exists for a reason, and we know how to use it. Or the biggest bag holders in history. Just saying.
Short-term chaos doesn't scare long-term investors. A crash simply means quality businesses go on sale at prices that weren't available the day before. If you own businesses with real earnings power, strong balance sheets, and durable competitive advantages, a market crash is temporary turbulence. The business keeps operating. The business keeps generating cash. The stock price recovers. Volatility also creates opportunity for long-term investors. Investors who maintain liquidity and discipline can purchase incredible businesses at discounted prices. Historically, the greatest investors made their largest fortunes during market downturns. Panic sells. Conviction buys. Time wins.
Someone hands you $10,000 and says, "Turn this into $1 million." Would your strategy realistically get them there?
With the right skill, discipline, and risk management? Absolutely. Small accounts have a massive structural advantage in trading. Percentage gains matter more. A trader with $10,000 can scale aggressively, take calculated, concentrated positions, and compound gains quickly. The math works. The opportunity exists. The market generates movement every single day. Is it easy? No. Most won't. But the ones who put in real work and build real skills, it's completely achievable. Gravity also pulls people down, you know.
It would take longer through value investing. I'll be honest about that, but the probability of success, the statistical likelihood that the money actually grows instead of going to zero, is meaningfully higher through disciplined long-term compounding. The most powerful force in all of finance is time and compound interest, and hype pulls people off cliffs. Give me 20 years and a handful of great businesses bought right, And I'll show you what real wealth creation looks like. It isn't glamorous, but it works.
Final stretch. Do you actually enjoy the process or just the money?
I love the game. The speed, the strategy, the competition. Reading the market in real time is like competitive chess at high speed. You're constantly processing information, adjusting positions, managing risk. Every day is completely different. Every day is a new challenge. The market is the most meritocratic arena in the world. Your P&L doesn't care about your feelings or credentials. You're either right or you're not. I love that.
I genuinely enjoy understanding businesses, figuring out why one company dominates its industry while a seemingly similar competitor slowly dies. Understanding the economics, what gives a business pricing power, what protects its margins, what makes its competitive advantage durable. That's endlessly fascinating to me. Money is simply the byproduct of being right over time. The process itself, the research, the thinking, the patience, that's where the real satisfaction lives.
What is one thing you genuinely admire about the other strategy?
I'll actually admit something here. Patience. Real patience. The ability to buy something, hold it through years of noise, drawdowns, and uncertainty, and not flinch. Most traders, myself included, would completely lose our minds holding a single position for 5 years. There is a genuine psychological discipline in that, something most traders simply don't have. I respect it, even if I'll never do it.
And I admire discipline, real trading discipline, the ability to cut a loss immediately without ego, without hesitation, without hoping it comes back. That is genuinely hard to do. Most investors hold losers too long because they can't emotionally accept being wrong. A good trader's relationship with being wrong, accepting it cleanly and moving on, is something every investor could benefit from learning.
Last question. What does the other side secretly get right that you'd never fully admit out loud?
The market moves faster than most people will ever realize. And sometimes, just sometimes, the patient long-term investor who bought a great business and did absolutely nothing outperformed everyone who worked 80 hours a week on charts. That's humbling. I won't dwell on it, but it's true.
And the market rewards patience far more than people expect, but it also rewards speed, adaptability, and precision in ways that long-term investors often ignore. The truth, both strategies can build serious wealth. The real question isn't which strategy is better. The real question is which strategy fits you, your temperament, your time, your psychology. Know yourself. Then pick your weapon.
And there it is, the rarest trait of all, mutual respect. 2 styles, 2 mindsets, 1 goal, profit. Whether you're watching the clock or watching the decade, the market has room for both. Thanks for watching. And remember, the best investor is the one who actually knows what they're doing. Choose wisely.